but more recently joined Madeleine Albright in starting the Albright Stonebridge Foundation as a co-founder. And he serves on some unique boards that it will inform us. So he currently is a trustee of Yale for the ULEs, and also works with David Swinson as a member of the investment committee of Yale Corporation. He recently joined the Brookfield Properties board as well, and has been a long-term board member of the Common Fund. And not until recently, he was also on the board of DC, the pension board. So it is with that, I will pass it to you, Michael, to introduce our guest and begin the fireside chat. Thank you all.
Oh, thank you, John, and thank you for just having us at this roundtable, which is a really important event. Look, SVB Capital has just been, one of the class acts in any institution, and what John and Aaron and Caroline have done, I think, is really powerful. Their commitment to building a great firm with the right values, and their commitment to diversity and inclusion is really evident. They're great friends. I have an incredible amount of respect for them. So it's really great for me to be here. It's my pleasure to be able to introduce Mark Spendel, the new Chief Investment Officer at the DC Pension Board. Mark has come from Potomac Capital, River Capital, which he grew to over $800 million in assets, really managing global macro hedge funds with a specific focus on macroeconomics, central bank policy, and capital markets. Before that, Mark spent nearly 10 years at the World Bank, where he was Deputy Treasurer and CIO of the IFC, managing over $15 billion in reserves, and had a really storied career before that at IBM Ambrose UK Asset Management business and at Solomon Brothers. It's really great to have Mark at DCRB. He's going to definitely up the game of the pension fund. Mark, it's great to see you. I know you're just settling in at DCRB. I think it's 6 months this week, if I'm not mistaken. How's it going?
We've had our moments. Let me first and foremost join you in thanking Silicon Valley Bank, thanking John, Aaron, and Carolyn for the opportunity and the invitation to speak this morning, and really for getting a chance to talk to you, Mike. As I said, we've had our moments. I'm not sure the audience fully appreciates that you and I hot-seated roles at the District of Columbia Retirement Board. I did come in as the new CIO just 6 months ago. I keep saying I've been here for 15 minutes, but 6 months has felt like 15 minutes, just as you rotated off the Board of Trustees as the chair of the investment committee. And what a year it has been. I think since we started talking, I should say right up top, it's been the most important and by far the hardest investment job I've had. And I think that we've been successful really hides how challenging a job like this, and my peers today realize how challenging these jobs are. I should also say that I think, and hopefully we seem to be getting closer to resolving the pandemic, and that all of us and the audience is safe and healthy and sound. But I think the collateral economic crisis, although it's certainly easing a bit relative to a year ago, Mike, when we first started talking, it's just nowhere close to being resolved. And I fear that there will be some ongoing scarring of the economy, especially in the labor market, with nearly 10 million workers still unemployed. We are in Washington, and I'm hopeful that the new political constellation can aim to address the root causes here. But all in all, as investors, I think it makes financial market successes kind of hard to fathom. Even after my own career, you recounted a long career in asset management, studying and trying to invest in complicated times. This overlap of politics, policy, and economics, to be sure, public pension plans in 2021, probably all 5,300 of us, really are at the leading, although I guess in the technology biz, we can say the bleeding edge of many of these complexities.
Yeah, so can you go into some of the biggest opportunities and challenges that you're encountering, particularly at DCRB?
and certainly it's an extraordinary portfolio. And when we first met, I think the most important resonance is that we're serving some of the most important people in the District of Columbia who have served you and me, our colleagues, our family, our friends for so long. This is the retirement plan that funds benefits for the Capitol's teachers, firefighters, and police officers. What you can probably piece together is that asset growth has really continued apace. We're over $10 billion in assets now. That's up significantly since I joined. And for the most part, broadly diversified like traditional public retirement plans. But I think uniquely, we're among the most well-funded, can I say state? Maybe among the most well-funded state and municipal pension plans in the country, just over 100%, which means we can really focus on the long horizon, this kind of investment North Star, the 15-year stream of benefits for our members. And hopefully we can invest it optimally and prudently for DC's taxpayers. The challenge, as we discussed, if I can really distill it, is that we need to turn every dollar we have, all 10 billion of them, into $1.07 just over a year and every year thereafter. Defined that way, it sounds pretty straightforward. But assets are expensive, interest rates are lower than low, risk-free real perpetuities, what you and I once discussed as maybe the ultimate goal for these kinds of plans, they're negative. You actually have to pay the United States government for the luxury of lending them money. On top of that, I think we give up some nimbleness when you move from $1 billion hedge fund to a $10 billion municipal pension plan. And who wouldn't have enjoyed some nimbleness given the wild swings lately? But I think this, and sort of reporting to the team here, the smallness of our investment team at DCRB, it's been a feature, I think a comparative advantage in this regard. Maybe the challenges to your question define the opportunity. Increase diversification, invest in innovation, dare I say, with a long career of studying the Federal Reserve, get ourselves as far away from the Fed for the time being, engage our stakeholders to ensure their fiduciary objectives are understandable and achievable. Again, that dollar into $1.07. All the while amidst a market that is more volatile than ever, more dependent on these politicians and policymakers, at a time of huge partisan polarization. That's not lost on any of us. And hopefully offering them, if not inviting investment attention to a whole range of potentially important ideas, assets, and to the topic of the day to investors.
Yeah, so Mark, what do you mean by that? I mean, in particular, given the fact that we have a long-term horizon, we're fortunate enough to have one at DCRB, and there's a lot of work that does need to be done, both within DCRB, but at the broader policy level. How are some of the topics today consistent with the long-term objectives, and in particularly as it relates to diversity and inclusion?
So I think the simplified description of our mandate, as defined by the board, your former colleagues, it does understate the prudential requirements to do so. The need to be diversified, the need to be prudential. At the same time, we know we have to take on additional risks. And the expectations that we can engage a range of managers who can help us do that. With those risk-free real rates around -1%, adding 4 or 5 or maybe even potentially 600 basis points of risk premia, in many ways it is a bigger challenge than ever. In that regard, we're making asset allocation decisions, trying to hire the best managers we can to deliver these results. We're researching and meeting managers, a huge due diligence effort to make sure those managers do and can do what they claim, and that they are successful, fair, and responsible stewards of the district's public capital. Again, the spectacular market moves up and down over the past few months are somewhat of a sideshow. Much as it was when I ran the Potomac River Capital Hedge Fund, We're not trying to throw strikes on every pitch. We really are trying to build a championship team for the long haul. And I would say a particularly important element of that is this heightened attention to engage newer, emerging, and diverse investment managers. For me, it's certainly exciting, important, and really compels us to talk to firms that are smaller than your typical bulge bracket firms that do manage the lion's share of assets, ours included. You know that I was a small startup investment advisor nearly a dozen years ago. So at the very least, I try and can provide some real world kind of dirt under my fingernails to what these entrepreneurs are enduring. It's just very hard, as many of my peers on the call today will appreciate, it's really hard to get allocations from large institutional investors.
Yeah, so is that working, Mark?
Kind of. Certainly too soon to tell, and I think the admonition that we all need to be better, maybe option D, all of the above. I will say, for the first time in DCRB's history, we are required to proactively report out managers of the pension plan that are emerging and diverse. And I think just that kind of sunshine should continue to compel us to engage this very vibrant cohort of investors. You know, I'm a student and a studier and a historian of the Federal Reserve. And so I do like to quote the greatest of all time, Janet Yellen, always Chair Yellen to me. She said it best last year, admittedly addressing higher education and the Academy's efforts therein. She said, first and foremost, it's about basic fairness. If managers can deliver the stream of investment returns that satisfy our return, risk, diversification, our prudential objectives, we should hire them. We should look hard to discover those managers, mentor them, as I said, provide them the kind of mandates that will deliver mutual success. Make sure that, by the way, this is me, not Janet talking. Make sure our investment constraints and policies invite managers of all types and stripes. Given our fiduciary responsibilities, what Chair Yellen went on to say, I think is particularly poignant. She said, quote, diversity is especially important because diverse perspectives inspire the best ideas and decisions translating into better results, end quote. Okay, again, she was talking about economics, but she might as well have been talking about asset allocation. And ignoring her admonition could lead to a myopic sense of the most pressing problems and the most relevant ideas. She went on to say, and believe me, I will quote her at length when we need to, but she went on to say bluntly and a bit overgenerally that, quote, women and men have significantly different approaches and views on public policy issues, which means that women's voices and those of minorities need to be heard. Our industry, asset management, particularly public pension fund investors, but really most people find safety in numbers. We are HERD, herding creatures. What's New York Common doing? How about Yale's endowment, or CalSTRS, or Texas teachers? People and investors just take comfort in these kinds of large cohorts. Another great investor, Benjamin Graham, once said, however, to do well, you have to be smart and you have to be different. Soros himself advised not to play by a particular set of rules. He said, look for changes in the rules. I know you get the idea. Smaller managers, more diverse thinking, more inclusive teams, they just make better decisions. If there's a better example of doing well by doing good, I really define you to find one. Okay, you did ask me, is it working? Not nearly well enough. We just have to work harder and champion our successes. If I may just give you one true story. We will, in this year's CAFR, our annual report, identify 2 of our managers who are emerging and diverse. I wish the legislation by the DC Council had characterized the reporting mandate as emerging or diverse, but alas, you can't fight City Hall. In any event, One of our managers focuses on small cap value stocks, and naturally over the last few months has just had tremendous success, only very partially of DCRB's making, but they just recently tripped over the $2 billion mark, which is what the District of Columbia defines as emerging. Now, obviously they are still diverse, but will now graduate from this program. It's terrific, but I don't want our stakeholders to think we rest on that kind of advance. And to be sure, they still manage a nice portion of DC's plan assets, and our annuitants are better off for it. But given these kinds of reporting requirements, you can bet we'll continue to try and identify public and private managers who can and can continue to satisfy these important objectives.
So Mark, anything else?
You know, as I said, it's a hard job, bordering on impossible sometimes, with a complicated, inherently conflicted set of stakeholders by design, employers and unions, active and retired members, executive versus legislative objectives, experts and annuitants, and so on. But I think the asset allocation efforts, that challenge of building a championship team for the next 5 to 10 years, means the substance we're discussing is the most important and actually fun part of the job. We also tend to usually think about ownership when we discuss diversity and inclusion, but I think that's even evolving, and kudos to your colleague David Swenson for reminding us. We want to make sure that the diversity that Chair Yellen references is visible at all stages of the decision-making process. So we're trying to look at staffing of associates, of risk managers, compliance officers, SURE front office teams, PMs, operations experts, product specialists, and on and on and on, simply to assure that our partners have the ability to make those better decisions. And I think for the District of Columbia, the size of our plan, it really does give us the privilege of investing directly in the broadest range of innovative investors, where we can hopefully repeat that kind of impact that I described. That's been another innovation, really trying to find the best managers we can for the overall and specific mandate, and working as hard as possible to engage them. After all, we do tend to stick with our managers over cycles, multiple cycles, and so getting through our due diligence efforts can be existential for this, this exciting cohort. The process we've put in place, and I really do have to thank you, Michael, for the carpentry, the plumbing, the scaffolding therein. It really is to think about the opportunities, the risks, the ways our assets and our asset managers behave with respect to one another, make sure we monitor and revisit the decisions every day, assess the likelihood of meeting or falling short of that $7 goal year after year. But I also like to point out, make sure we don't or try to avoid banana peels along the way. And anyone in the investment business knows that there will be some banana peels. I like to think of investing about identifying these opportunities, understanding and accepting these inherent risks, and sometimes making mistakes, learning from them, and moving on.
Well, Mark, looks like we're right about at our 20-minute time. I could talk to you for hours about these issues.
We have and we will.
We have and we will. But I can say with certainty, there's no better coach for a championship team than you. And really, really excited that you're in our nation's capital and pushing forward the DC Pension Board, particularly as in all dimensions, but particularly in our efforts to be the most diverse and inclusive fund as well.
Thank you.
So thank you.
Well, thank you both, Michael and Mark, for that conversation. And I do appreciate you challenging us, Mark, to think differently and maybe break a bit from the herd. It's a great setup for our next panel. So let me now pass it over to my colleague Carolyn as she brings on our venture investor panel.
Fantastic. Good morning, everyone. So I'm an investor on the SVB Capital Funds team, and I'm grateful to have the opportunity to take part in these conversations today. We have the privilege of being joined for this next panel by 3 distinguished venture investors. And in the interest of hearing from them as much as possible, I'll keep the introductions very brief. Our first panelist is Theresa Gao, founding partner at Accrue Capital, and previously was founder of Aspect Ventures. Before that, she spent 15 years at Excel Partners and was the firm's first female managing partner. Our second panelist is Anu Duggal, founding partner of Female Founders Fund, a seed stage firm focused on the simple belief that the best companies of tomorrow will be built by women. And our third panelist is Samara Hernandez. Samara is founding partner at Chingona Ventures, a pre-seed and seed stage firm. Her focus is on deploying capital into the hands of a diverse set of founders. We, like the panelists and like those we just heard from previously, believe, and the data clearly shows, that companies, venture firms, boards who are well represented by women and by other diverse individuals both make better decisions and outperform. And these individuals with us today are investing with that in mind. So I think with that, we'd love to kick things off. And I think an exciting place to start would be to hear some self-reflections. Each of these investors have been in the technology and venture ecosystems for a number of years, and I'd be curious, and I imagine others on the line would be curious to know, what were the formative experiences that led you to do the great work you're doing today and to become venture investors in the first place? So maybe, Theresa, we can start with you.
Thanks, Carolyn. Thanks for having us. Another aspect of that you asked was, so how do we get into the venture industry, and was it something that we were called to do, or did we think there was something that we could contribute? I have to say that being in the venture industry was not something that I thought about as a young child. I didn't even know it existed until I came here to Stanford. I'd immigrated to the United States from Indonesia with my parents when I was a small child. We left after the revolution, the political revolution in the late 60s, and amid the anti-Chinese backlash. And we ended up settling in a small town of 2,000 people outside of Buffalo, New York. So I can say that venture was not something I even knew existed, and I barely knew anything about business, in fact, until much later in my career. But what drew me to venture is, I've always loved technology. That's why I was an engineering major in undergrad. And I came out here to Silicon Valley, like many immigrants within the United States, because I was really interested in tech, and I thought I'd be a product manager at a big tech company. But then when I came out here to Stanford, my eyes were open to the world of startups and venture capital. And so shortly after graduating, I was fortunate to be asked by a couple of my Stanford classmates to join them after they had just received their first seed round of funding at their startup. And during that time, I helped raise 3 rounds of venture capital. That was my first exposure firsthand to venture, was on the other side, and even helped to write an S1. But this was the late 90s when concept IPOs were a thing. We didn't quite make it out because I didn't know a whole lot, but I saw that we had 3 different CEOs in 12 months. I figured that was probably not a great thing for my stock options, and I went to one of my VC board members, and said, I would love to go to another startup. And like many of us, I think, he turned out to be a pivotal person who made me see myself in a way that I never thought of. He was like, well, I'll introduce you to 3 startups, but I'm also going to introduce you to 3 venture capital firms, because I think you might, it's the late 90s, they're growing, they're looking to hire young people. And that was how I ended up joining Excel in 1999. Just wrapping up, as you said, Caroline, spent a lot of years there. Later in my career, that was really when I felt finally a calling, like I belonged. And that was when I decided, what I'm going to do is I'm going to go out and start my own firm. And that led, as you said, to the co-founding with my 5 teammates of Accrue Capital. And that was really when I felt like I could do something in the venture industry. I'd been here long enough. And Accrue was really founded on 2 core principles. The first being a strong, deep domain focus in 5 key areas. But the other is something that Mark just spoke about, which was diversity of perspectives. We believed from day one, it's on our website, our core values, that leads to better and more inclusive decision making. And as a result, that felt like that was something that was needed in our industry. And I'm really happy to see my other panelists and all the work that SVB is doing to help bring different thinking and different types of leaders to the forefront in venture.
Thanks, Theresa. Maybe Samara and then Anu would love to hear you respond to the same question.
Yeah, and I didn't realize Theresa and I had, I guess, a similar story when we were young, but I also came from an immigrant background. So I was born in Mexico and I moved to the US in the 80s. And so non-traditional, grew up in a low income, dual language, multicultural household. And then I didn't pick up English as quickly, but I picked up math quickly. So I also did engineering in undergrad. I think that's just a universal language. And so we can all, be kind of equal there and push the limits in math and science. And so that led me to then a role at Goldman Sachs. And so I was at the public side for about almost a decade, and then went to my MBA at Northwestern. And almost by accident, I applied for a role at a VC firm. I didn't know if that was for me, but it was actually a group of 4 women that were preparing for interviews, and we all were like, "Hey, we should try this. I don't know what this looks like, but we should try it." And so, while I got into venture, not surprising, I saw a bunch of different opportunities. And, being someone that's the youngest, the only female, the only minority in the room, and seeing the same types of deals getting funded, the same types of founders. And, I got to a certain point where I was at a fund that I had been there for through Fund 1 and Fund 2 for about 5 years. And I had enough data points where I was like, okay, these founders that we passed on, I don't really know why. They had all this other stuff, but maybe they didn't pitch well, or maybe they didn't have the network, or maybe whatever it is. But I had enough data points where I'd seen that they had grown their business, or they had raised additional rounds of funding, or they had even exited. And so I just thought, okay, this is the time. If not me, who else? And I don't know how I'm going to do it. I don't know who I'm going to get funding from. I have no high net worth individuals in my network, but I'm going to go and jump and do my own fund. And so that's what led me to launch Chingona Ventures. And really the thesis was on backing these incredible humans that had these amazing backgrounds, but didn't have the right network, didn't go to the right college, didn't know the language, and being that first check in and really catalyzing the round and the growth of the business. And so I'm so excited now to be on this panel with everyone, because I feel like there's a lot of similarities that we have, but we're all tackling it in many different ways, which is what we need to grow the ecosystem.
Fabulous, thank you. And Anu, would love to hear from you too.
Great. No, first of all, thanks so much to SVB for putting this together, and love having Theresa and Samara on this panel as well. I guess by way of background, I also had kind of more of an international background. So I grew up in India and spent most of my childhood between kind of Tokyo and Hong Kong, coming to the US for college, and kind of starting my career in New York. And I kind of knew, from the get-go, I was the kid who was always doing the lemonade stands and, trying to raise money for different fundraisers. So I knew that I had an entrepreneurial bug. And so prior to starting Female Founders Fund, I actually had started two different companies. So I'd opened India's first wine bar, and then right before starting Female Founders Fund, had co-founded an e-commerce company based in India called Exclusively In, which was actually backed by Tiger and Excel. And it was an incredible experience, the highs and lows of tech entrepreneurship. We raised $20 million. And I would say, it was a pretty clear moment for me in terms of, when I thought about the concept of Female Founders Fund. So, I never, to Theresa's point, I had no idea about venture growing up. My first exposure to it was really through fundraising for our company. And the real takeaway for me through that fundraising journey was that almost everybody we met was male. And, you looked at our employee base, our customer base, almost everybody was female. And it just didn't make sense to me. You'd seen an increase in diversity across so many other industries. And yet venture capital, to me, looked very much the same, which was, less than 2% of venture capital went towards women, and almost all the decision makers were male. And so, when I looked into the numbers and realized that, there's a pretty fundamental issue at stake here, I also looked at the other side and looked at, where are the women? Are there women who are trying to raise capital? And this was in, 2011, 2012. You were starting to see, women like the founders of Guilt or Birchbox, and they were, being successful in raising capital, but there were many other women who were really having trouble getting access to that first round of capital. And obviously, if you can't get access to that first round, you're not well equipped to kind of build that billion-dollar business. And so my macro view was that this is going to change, and you have a generation of women who've worked at large tech companies, who've helped them scale and have the right skill sets. If you're able to provide them with access to capital and the right networks, they are just as, they have just as much opportunity to build that next unicorn. And so with Female Founders Fund, the idea was to really obviously raise a pool of capital, but more importantly, to really change the ecosystem and make sure that not every tech event looked like it did in 2010, which was basically the same demographic of white men. And so, we run 30 to 40 events a year and really try to highlight what female founders are doing, not just within our own portfolio, but women like today, Whitney Wolf-Herd, with the Bumble IPO. So yeah, that's a little bit about my story that got me into venture.
Thank you. Yes, appreciate you all sharing those anecdotes and your personal journeys so far. I think the female kind of founded and minority-led firms and platforms that you've built definitely signify that there has been an evolution in the venture industry, but still obviously a very long way to go in terms of creating a diverse pool of investors and entrepreneurs. I'd love to hear what progress you've either witnessed in the ecosystem or helped bring about that you're most proud of. And maybe, Anu, we can start with you.
Sure. So as I mentioned, when starting Female Founders Fund, the idea was, again, not just a pool of capital, but also to create really an ecosystem. And so, we did that through a variety of events, through creating content that highlighted female founders, but I think equally importantly, also tracking progress. And the way we did that was we started publishing an annual report that looked at the amount of funding that went to female founders. And this was, 2013, I think one of the first reports of its kind. And we focus on the Series A because there's no way women are going to raise hundreds of millions of dollars if you can't even raise a Series A. And when you think about progress, in 2013 in New York, there was one Series A round that was led by a female founder, and that was Shanlin Ma of Zola. In 2018, there were 18 Series A rounds. So, again, it's not hundreds of millions of dollars, but you have to build a base and a foundation in order for things to change at kind of those higher levels. I think in terms of our own portfolio, our thesis is very clear that it's possible to generate top tier returns by investing in a portfolio that's 100% female. And, we're still early in our journey, but I think, looking at firms like Lightspeed, Goldman Sachs, Sequoia, that have gone on to back our founders, for me is incredible, because those women, are now running companies worth hundreds of millions, and the wealth generation that's being created for them and for their employees, many of whom are women, is incredible. So I would say that's what we're proud of at Female Founders Fund.
That's remarkable. Thanks for sharing. Theresa and Samara, any perspectives you'd add?
Sure, yeah. I see really four opportunities or insights that I'm seeing in the market that I'm really proud of. So the first one is just even beginning the conversation, right? So a few years ago, it was through the Me Too movement, and last summer it was through the very unfortunate events that happened, pushing the conversation around racial equity, which was not a conversation that we had had in the past. And so the push to have these conversations is a first start. People reaching out to funds like mine and others to set up quarterly meetings, to talk through our deal flow, talk through our portfolio and figure out who's raising next. So, and then even figure out what they're doing internally that they can change, because they're seeing founders that are diverse, but they're not actually investing in them. And so helping them think through that, I think, is really important. That's a start. Now, obviously, the next step is to actually write a check, but I'm proud of these conversations being started. That's how we start to drive change. The next thing is a new set of LPs coming to market. So corporate VCs are interestingly stepping in. I've seen a lot more of them coming in, because for me, I'm particularly seeing this. Many institutions that we talked about before, where they don't come in with funds that are under 100 million or under 50 million. And so many corporate VCs can come in with, call it a $1 to $5 million check, which is significant. And they don't typically ask for, crazy terms or they want to invest, and they want to invest through deal flow, and they want to support you. So I've seen that with some of my Fund 2 investors, and some others like non-traditional investors, women, minorities. I know Theresa's doing a lot around this with her new fund. And so I love seeing these new types of investors. The third thing is on teams realizing that diversity is not just for a check the box and hire a woman, but it's diversity around your team, around the cap table, around even the funds and the LPs that go into these funds. And for me, I also invest in non-diverse teams. I've invested in all straight white male teams, and they seek me out, or I'm able to win an allocation because I'm able to provide a unique perspective. Sometimes I'm the only person on their cap table that's in their consumer demographic that they're selling to. So being able to provide that diverse perspective. So that's why I also invest in non-diverse teams, but I've seen more of that conversation. And then the last thing are these groups coming together to really help support us. So there's Transact Global, there's Women in VC, there's Black VC, All Raise, Latinx VC, Operator. These are powerful networks coming together where we can have intimate conversation about fundraising, the struggles, negotiating, right, hiring. And so it's democratizing this information that in the past was only available to a few. So those are the 4 things that I'm really excited about that's helping to change the ecosystem.
So I don't know if you can see me, but I was nodding during a lot of what Anu and Samara were saying. So I won't rehash, but I completely agree, especially with several of the trends that Samara was highlighting. So, like Samara, A Group has diversity as one of its 2 core tenets alongside domain expertise. We invest in the best founders in our sectors. There's not necessarily a diversity lens in it. But maybe not surprisingly for any of you who've read any of the studies, the fact that the A-Crew investing team is almost 2/3 underrepresented as defined by women, Black, Latinx in tech, and actually 88% of the team are women or people of color. Our networks look different than the average traditional Sand Hill Road VC firm. And as a result, about 2/3 of our portfolio has a founder on the team that is a woman or a person of color. They happen to be the best founders in things like fintech and also in security and other things. And like Samara, many of them are not diverse, but they are seeking us out, or we are winning a spot in their heavily oversubscribed rounds because they want diversity around their boardroom, in their cap table, because they want to access different networks than the ones that they already have or their existing investors already have. And so Samara hinted on it a bit. So the thing that I'm proudest of, so first I just want to say, again, thank you RFK and thank you SB for having this panel. I've been in the business, as I tease myself sometimes, since the last millennium, which is true. And it's amazing to see how much change has been brought about. And it's really based on the leadership of organizations like SVB and RFK who are bringing leaders like Samara, Anu, and myself together, who are part of a different 1% club that people might not know, which is we're part of the 1.1% of all private asset managers. That's about $71 trillion in the US that are running firms that are managed by either a woman or person of color. So 1.1% of that 71 trillion is managed by someone who looks like Anu, Samara, or myself, or a Black or Latinx or Asian man. So we've made a lot of progress, and Samara talked on some of those things. We still have a way to go. But the one step that ACREW has launched last week is our ACREW Diversify Capital Fund. And that is, on the one hand, a fairly traditional late-stage growth or opportunity fund in terms of the types of companies that we're seeking to invest in, which are the market leaders in our 5 key domain areas. But what's really different about it is that we are bringing to the table a diverse set of individual LPs alongside our institutional LPs who are all women or people of color who are executives in tech or in the business world, and giving them access to, I know when I started out in my venture career, what used to be thought of as the coveted executive and entrepreneurs side fund. And we are opening that up to a much larger group of individuals, very purposefully and mindfully, because we know that this is a way to create a triple bottom line. We can deliver strong investor returns because indeed these companies, as Samara said, many of them not diverse, are actually making room for ACREW DCF in their heavily oversubscribed late stage rounds because they want access to these diverse investors and their networks at the time when they are a year or two away from thinking of being public companies, and adding independent board members, growing their management teams, growing their advisory boards, and wanting to tap into more diverse networks because they've seen the studies from McKinsey and others that by having a diverse management team, board, and cap table, you actually increase your return on shareholder equity by anywhere between 20 to 35%. And then lastly, and this is important, like personally, is it's bringing a new set of individual investors into venture capital and creating wealth creation for them, and creating sort of more opportunities for them to become, individual angel investors, kind of all the way back to the beginning, to the seed and pre-seed stage as angels alongside potentially Samara and others, because we know that it's human nature. When you have enough capital and you start to invest in other companies in your space that you invest in people. So you tend to invest in people you know. And if you have a different lived experience and you have different networks, it is far more likely that those people you invest in will be more like your lived experience, more like your demographic than not. So we think it starts a virtuous circle.
Thank you. That's remarkable. Appreciate you sharing everything you've done and are doing to change the ecosystem. And I think we're out of time, but I think this has been a really inspiring conversation. Appreciate you all joining us and taking time from your busy days. I think with that, I'll turn it over to my colleague, Aaron Gershenberg, for the next panel. Thank you again.
Thank you, Carolyn, and thank you, Samara and Anu and Theresa, Michael and Mark, John, Sansia, Marvin, Rain. This is just an unbelievable gathering, and our attendees, thank you so much for taking time out of your day to join us. I am just so blown away by this last panel. I can't imagine why anyone and everyone on this call wouldn't want to be trying to figure out a way to put some money to work with this group. And before I challenge my LPs on this call, encourage them to join us as well. I do want to ask them to introduce themselves in the context of their roles, what they're doing at Pivotal Knollwood and University of Chicago. We'll start with Aaron. What I'm really hoping for this panel is we both share with you, and in the Q&A to follow, that you challenge all of us. As Mark said, it's not enough to do what we've been doing. We all have to find a way to work harder, to work smarter, to work differently. We can't look backwards. We have to look forward and know where we want things to be. and then we have to work together and collaboratively to get there. I think one of the most challenging things for me, and I know it's for my colleagues as well, as we go down this diversity and inclusion path, really committed to it, how much bias there is out there, right? There is, and RFK has been fighting this battle for years, which is why I'm so proud of SVB to be a partner to them, is this bias that somehow you have to sacrifice returns. And we don't believe that's the case. We think it's anything but the case. That the returns of the future will come from more diverse leadership and thought. And so with that, I'm going to turn it over to Erin to introduce herself and Pivotal.
Thank you, Erin, and thanks to SVB and RFK for bringing us together today. It's such an important conversation, and thankful for your leadership in bringing us all here. But good morning, I'm Erin Harkless-Moore, the Investments Director at Pivotal Ventures. We're an investment and incubation company created by Melinda Gates to advance social progress in the United States. So we work with organizations and individuals to generate momentum where progress has stalled, and use both philanthropic and investment capital to do that, to improve people's lives in our country. I lead our investment team at Pivotal and am responsible for identifying, investing, and managing a diverse portfolio of both fund and direct investments that drive breakthrough innovations and advance women's power and influence. So looking forward to the conversation with my panelists today.
Thank you, Erin. Kevin, would like to turn to you next.
Great, thanks, Erin. Hello, everyone. Good morning. Kevin Irwin, the President and Chief Investment Officer for Knollwood Investment Advisory. Knollwood Investment Advisory is a single-family office in Baltimore, Maryland. The family was known for a company called Noxzelle Corp, which developed the products Noxzema Skin Cream and CoverGirl. The really wonderful family that I've represented for about 17 years. We have a pretty interesting investment program, and I'm going to talk a little bit about it later when we start talking about capital allocation. But at Knollwood, we have a very long-term investment horizon. Everyone says that, of course, but we have developed a 100-year plan that has a pretty aggressive pre-tax return hurdle for us to accomplish our goals. And the reason I bring that up is that we've been talking about this question around giving up returns to invest in things like ESG and impact investments in D&I for a very long time, and would agree with the earlier comments that we don't believe that we're in a situation where we need to do that. So in terms of the investment program, very simply, about 2/3 of the assets are in publicly traded securities as a global equity program, and the other third is mostly committed to our venture capital program. And again, I'll talk a little bit about that later.
Thank you, Kevin. And Joanna, let's turn to you.
First of all, thank you for inviting me for this discussion. It is very important and timely, and appreciate the leadership shown. Joanna Rupp, I manage the private equity portfolio for the University of Chicago's endowment. The endowment is about $10 billion. We have a 20% allocation currently to private equity. About half of that is venture, and 2/3 of it is here in the US. We made our first venture investment in 1978, so we are fortunate to have some terrific partnerships with a number of blue chip firms. And over the last 7 or 8 years, we've been adding selectively to some newer managers. So it's given us kind of a unique perspective on the evolution of some of the emerging managers that are coming out. So.
Thank you, Joanna. Let's turn to the first theme that I would like to focus on. There's three. The first one is opportunities and constraints based on the capital that you represent. And I'd love to hear from you, Joanna, Erin and Kevin on this, but let's start with you, Joanna. Based on the capital you represent, and how are you approaching diversity and inclusion? Is it nice to have today? How have things changed from the last 5 years? And how do you see things as we look 5 years out?
So as I mentioned, we've been long-term investors in the asset class. So it is terrific in many respects, but it provides some constraints in other respects. 85 to 90% of our capital commitment budget goes to current relationships. So we support the primary focus on diversity and inclusion, or an important one, is to work with our existing managers and help them understand the importance of it, and help and dialogue with them about what they can do to support diversity and inclusion. Many of these are the larger firms, and we have seen some movement. It's not as significant as we would like, but we have seen movement. I think where we've added new managers, in 7 years ago when we started adding some new managers, we really saw the importance of diversity as a competitive advantage. So most of the new partners that we invested with had some kind of diversity. I would say roughly 2/3 of our new relationships have had some diversity. I would say 5 to 7 years ago, there was more of a focus on women. And in the last 2 to 3 years, there's been more of a focus on underrepresented minorities. And that's really accelerated in the last year or so. But we think it is an important competitive advantage. I think particularly as VC moves outside of Silicon Valley and is more dispersed geographically, there's more of an opportunity for some of these folks with non-traditional backgrounds to start companies and to be backed by GPs in different geographies. So it's been an important part of our program.
Thank you, Joanna. Erin, let's turn to you and get your thoughts on this one.
Sure. So, DEI is foundational to what we do at Pivotal. And for us, social progress means backing people and ideas that make our country more equitable for everyone. So the slide that John Chena showed at the outset, I think, crystallizes that really, really clearly, and putting equity at the center. So we're applying an equity lens throughout our work, actively engaging with and investing in women and people of color. So that's manifested itself in the portfolio construct of allocating capital to female-led funds and companies, women of color-led funds and companies in the early stage venture ecosystem. So that's predominantly where we're allocating capital today. And I think, echoing the comments that Joanna just shared, I mean, it's a must-have. Many of us on the call are familiar with the stats, and others have alluded to them, around more innovation, more creativity, more profitability comes from having a more diverse set of individuals that you're drawing into your portfolio. And, for us, at least, investing in female-led funds and female GPs should likely lead to more investments in companies with women on the executive team. So, the stat that women are, more than 2 times likely to invest in companies with female leadership there, I think speaks for itself and is going to impact the type of change that we want to see. So that's really where we're focusing, our energies from a capital allocation standpoint. The last 2 things I'll say, and I think the GP panel really hit on this, Samara and Theresa and Anu, so well, and what's changed. I don't think it's a pipeline problem at all. I mean, there is a robust set of opportunities to invest in out there, across asset classes, but specifically in venture capital. And there are more forums, there are more avenues to find them and to connect with them as LPs, including, events like this. So what will change going forward? I hope that we see continually more capital being deployed, 1, and 2, actually some results, right? The 3 GPs that were on the prior call, ICRU is raising their next fund. You can look back to their prior track record. Samara's on fund 2, Anu's on fund 3. And I think that will show us and show the market that there's real progress here, and there's real return, and there's real value to be had by investing in these diverse teams and their diverse companies.
Thank you, Erin. Kevin.
Yeah, great. No, I think that, I'll take it from just a little bit of a different angle. Again, for us, portfolio construction, capital allocation, is extremely important. And, we spend a lot of time understanding the symbiotic nature of our public equity portfolio and our private program. In fact, a lot of our public equity stocks have come from our private market program, whether they've been direct investments we've made over time or even equities that our fund managers distribute out to us. And so When you think about portfolio construction and portfolio diversification, what we've learned over the years is extremely homogeneous and highly correlated. When we think about how to try to build a long-term sustainable portfolio that's truly diversified, and we really do think about the venture capital. And the venture capital for us is our first chance to gain access to those best ideas in the innovation economy. And when I've spoken to entrepreneurs throughout my life, there's always one commonality, and that's this pain point that they've experienced during their lifetime. And this pain point is the genesis that helps them to develop these game-changing ideas. And so, from my perspective, if you really want to open up your aperture to idea generation, then you need to broaden your search criteria. You need to have a process that leads you to a diverse set of individuals that have lived through a lot of different experiences. And so, venture capital is changing, and I think we've been trying to be a part of that process. And I think when we look at our overall portfolio, 3 and 5 and 10 and 20 years from now, we're going to have a lot better idea generation embedded in it.
Thank you, Kevin. That's super helpful. Let's turn to our second theme. And Kevin, I think it'd be great if you would lead this. What investments have you made or programs you've participated in that you're most excited about? If you'd share a story about the process or how you sourced that opportunity, what you've learned, and any advice for consultants, GPs or LPs.
I think for us, at least, we're pretty proud of the breakout or early stage manager program that we built for first-time fund managers, and a disproportionate amount of that capital is either women-led or people of color-led in terms of against our peers. And so, when I think about that program and how we tried to build it, it was really relying on the GPs that were thinking more broadly, that were allowing us to get really great introductions, that allowed us to expand our network. And we couldn't have done it without them. And we're trying to do the same thing today that they've done for us. And so, for us at least, I think last year we did over 1,500 GP references to potential LPs. And so I think it's one of the ways that we try to show up in terms of our program and being part of the solution. I think the other thing that I'm pretty proud about is that we've done a very good job, I think, of extending our view of diversity and inclusion beyond the U.S. And we invest globally, like most people on the panel, and so investments in Korea and China and the Middle East and India. A lot of LPs won't go to these places, and we've made a concerted effort to do so. And I think we bring both the mentality and capital to underrepresented individuals that helps just raise awareness in some of these ecosystems. So, from my perspective, we have a global problem, not just a U.S. problem, and we're trying to be a part of the overall solution from that perspective. So those are just kind of two programs, I would say, on the capital allocation front in terms of what we've done. We've also attempted to do some things on the firm building front, and we're a pretty small firm in terms of the overall size, but a couple of things I think we've done that's really helped yield some results is that we've built out a pretty extensive intern program that feeds our analyst program. And inside that intern program, we're very targeted with trying to attract diverse and underrepresented students. By adding those backgrounds, we just get a lot better perspective. And we're seeing that as we hire these interns onto the team and allow us to just broaden our overall our thought process. One other thing we've done, Aaron, is that and unfortunately this really got hit and paused by COVID, but we started to develop an international student program that incorporates CFA curriculum. And what we're attempting to do is import underrepresented students across the globe into our investment program, making them a member of the investment team, getting them through the CFA exam, paying for all of their needs and what have you. Again, attempting to give people opportunity. Again, it's that was really stalled for a while there with COVID and some of the immigration issues, but something we'll pick back up. So those are just some of the things on the capital allocation and the firm building front that we've tried to do.
Well, that's fabulous, Kevin. You referenced something we're deeply committed to, which is building bridges, and both domestically and internationally. And you've been on the trips we've taken on how we we build those bridges, which are absolutely a critical part of this. There are some great questions coming in. Santia referenced that you can raise your hands. We'll bring you in to speak live. We're only recording the panelist piece of this. We're not going to record the Q&A piece. I have one more theme, but before I turn to that, Joanna or Aaron, on the theme of investments and programs that you've participated in that you're most excited about, is there anything you'd like to add to that?
I would just add, kind of building on what Kevin said, many of these firms raise smaller amounts of money, and you're backing, by definition, firms early in their lives. So you're taking new firm risk. And we've tried to think really carefully about how we can do that within our current program. So much like Kevin, we launched something called the Venture Launchpad program, where we would write smaller checks on a more diversified portfolio basis and back managers earlier in their lives. And that's been successful. I think one of the Q&A I saw came through reference, like, how do you get minimum commitments to these funds? And I do think that's one of the biggest challenges I'm trying to think through right now. We are willing to write first checks, and there aren't that many LPs that are willing to write first checks to first-time funds. And I think that is one of the barriers we need to cross to really change the environment and lead to more diversity. I'm encouraged by some of the fund-to-funds and other kind of pool vehicles out there that are beginning to step up to the plate and help some of these managers earlier in their evolution. I think we need more of that.
Yeah, I would just echo Joanna's point, and I think internal processes are ways that we can get ourselves comfortable with that first check, and that's really, a role that we like to think that we can play as Pivotal Ventures, is being there and Fund One and being early and supporting these emerging managers. But even still, you hear a lot of pushback or people saying, well, are you lowering the bar? There's not enough track record to evaluate. I think we need to step back and reframe, some of the bias that might be in our own processes, one, and two, how we can still do the robust diligence and ask these questions, but maybe we need to ask the questions a little bit differently and assess that risk that is present in these early life cycles of these firms, as Joanna mentioned, but not let that hold us back from putting the capital to work, right? So just something we've spent some time on at Pivotal, being very transparent with our own investment committee about how we're scoring, how we're evaluating these managers so that we can get comfort in putting that capital to work.
It's a real challenge. Having run a fund of funds for 22 years, it's a bit about concentration, and so there is this real tension. And thank you, Joanna, Aaron, and Kevin, for really being champions of thinking and doing different and challenging us all. I'm going to turn to you, Aaron, for the final theme, which is how do you think LPs need to show up? Should they be more public about their commitment to D&I? What sort of value should they bring to the table? What are the things you're focused on? And is there enough transparency with GPs about the process and about the LPs in the ecosystem and what they're doing?
Sure. So I think that there's work to be done on all three of those points you raised, Aaron. LPs could and should be more public. I mean, we're all here talking about the programs that we have, the ways that we're engaging. And I think being more clear, and we can do a better job of this at Pivotal ourselves, turning the spotlight back internally, being more clear on our website. DEI is embedded in our mission as part of our North Star, but even still, I think I try and lead with that and be as transparent with that as I'm having conversations with GPs so that there's really clear, where the alignment might sit. In terms of value beyond capital, I think there's so much we can do. And, other panelists have touched on some of this, but providing clear feedback, we're not going to be able to invest in everyone, but if there are things that we see that, could be a spot for improvement or an opportunity to maybe position something a little differently, share that, don't hold back and let people continue to come to market, with something that might be, causing them issues as they're engaging with prospective LPs. Making connections and opening your Rolodex. I try to ask, how else can I be helpful? And a lot of GPs are very good about asking this of us, and I think all of us on this panel are open to doing that, right? You may not be a fit for our portfolio today, and we might not be investing today, but that doesn't mean this is a long relationship, and we can continue to support these managers, again, in other ways, and making those connections and putting them forward to other prospective LPs that might be a better fit for their portfolios. So I think just greater transparency about the process is definitely needed, and communicating that up front. And it's something that, you know, we can all do better at.
Thank you, Erin. Joanna or Kevin, anything to add? And then I think after this, I'll be turning it over to you, Sansia, to moderate Q&A. But first, before we do that, Joanna or Kevin.
I'll just mention a bit on the transparency for just a moment, because I think it's really important. And I draw experience again from the public equity portfolio. So we've seen the rise from SRI to ESG, and why has ESG been able to gain the momentum that it gained? And the answer is technology and transparency. I own over 400 stocks in our public portfolio, and I know every single rating that's going on inside each of those companies and their strengths and weaknesses across all those characteristics. And we don't have that transparency in the venture capital ecosystem. It's traditionally opaque, and we need software and technology to help disrupt and enable transparency so that people can better evaluate what's going on inside the overall companies and portfolios.
I would just say I agree with what both Kevin and Erin said, specifically with what Erin said. And I think as we think about engagement with our VC managers, we really double down on our existing managers, helping them understand the value we place on diversity and inclusion. And then in all of our interactions with potential new managers, trying to give very specific feedback. And it is a capital intensive kind of effort. We spend a lot of time with managers that we meet, particularly if we start to underwrite them. And, I think to really change the ecosystem, we're going to have to be backing managers who have non-traditional backgrounds, because there isn't a sufficient pipeline in established VCs. And that means a commitment to really partnering with some of these folks as they try to understand what is the LP lens, what is it that we care about. I'll give one real quick specific example. We're underwriting a manager right now who's making a very modest GP commitment. And we're fine with that because we understand their specific and personal economic circumstances, and they don't have the capital to put in. But we ended up, walking term by term and say, you know what, you can actually do a management fee. And that's going to help you be more aligned with us. And it was interesting to me that their counsel hadn't given them that feedback. And I have to imagine that as they've met with LPs, when folks looked at a $5,000 GP commit, on some level, it didn't get through that initial screening process. So I think the LPs have to be willing to spend their own time in really helping these GPs understand what our lens is. And be
well, thank you.
Our lens too. I should add. We need to understand there may be times when we need to change that lens too.
Absolutely. Well, Joanna and Erin and Kevin, thank you so much for your leadership and your partnership on diversity and inclusion. I'll turn it now over to Sansi and her amazing team to take us forward on Q&A.
Thank you